Hi, thanks for joining me on this web broadcast to talk about analyzing and valuing stocks with YCharts 1% focus reports. My name is Eric Kobayashi Solomon. I'm the Director of Research here at YCharts. None of what I am going to present to you today should be construed as investment advice. On the agenda for today, we're first going to talk about what drives the value of a company and how to analyze these drivers. Then we'll talk about turning a valuation analysis into an actual valuation. And all of this is leading to how you can use YCharts 1% focus reports as a tool in valuation analysis. What drives the value of a company? Well, I've come up with a golden rule of valuation that we use here at YCharts. That is, a value of a company is simply the wealth that it can create on behalf of its owners. Notice that this definition all revolves around cash flows and cash. I think cash is the best thing to look at when we're thinking about valuing companies because first, it's an unambiguous store of value, and second, it is easy to count. It's not an estimate. A lot of the line items that you see on a financial statement are actually estimates, and cash is much easier to count. So how does a company generate cash flows? It has to first generate revenues, then convert some portion of those revenues into profits. If the company has some excess profits after it has generated its revenues, it can use those excess profits and invest them to try to boost growth in the future. These are the drivers that anyone must analyze when they're analyzing a company. Let's take a look at them one by one. First is revenues. Revenues are a product of price and volume. You can either sell a lot of stuff, a lot of cars in this case, or you can sell stuff for a lot, one very expensive car. Revenues are not a simple year-over-year percentage change. A lot of investors and analysts make this mistake, extrapolate in an inappropriate way, and wind up unhappy. This is one of the things, the real cornerstones of analyzing a company is understanding the economic transactions that go into the revenues that the company is generating. After revenues, we turn to profitability. A company has to pay costs. Some of these costs are direct ones. These are salaries, price of building inventory, taxes, interest, etc. And once those cash costs are deducted from revenues, you come up with cash flow from operations. This is an actual line item in a financial statement, the statement of cash flows. However, not all of the costs that a company must pay are direct ones. Some of the costs are costs to maintain the business as a going concern. Because they're used to maintain the business, we call them maintenance CapEx, maintenance capital expenditures. At YCharts, we use a special bit of jargon called Owner's Cash Profit, or OCP. This is meant to show how much cash is left over once all of the necessary costs have been deducted from revenues. It goes without saying that revenues and costs drive profitability. We have revenues, we have to pay some direct costs like these, have to pay our maintenance CapEx costs, and once all of that is paid, we have owner's cash profit, OCP. After a company has generated OCP, it can do one of two things with that profit. First, it can return cash to owners. Now remember, our definition of the value of a firm hinged on the amount of cash that it was returned to owners. So in this case, if a company returns all the cash to owners, the free cash flow to owners is equal to the owner's cash profit. It's this free cash flow to owners, or FCFO as we call it, That is the metric that we're going to measure to try to determine the value of a firm. Now, if it doesn't return all of the cash to its owners, the other choice is to make some investments. Now, obviously, if it makes investments, the free cash flow that can flow to owners is less than the owner's cash profit. Is this a bad thing? Obviously, the owners get less money out of the company right away, but it's not necessarily a bad thing. In fact, to decide whether it's good or bad, we have to think about investment efficacy. Now, there are two things about investments. They're risky, and they take some time to assess. You don't really know whether you'd be better off if the company would have paid you as the owner all of its profits, or whether if it would have been better for the company to invest those profits or some portion of those profits to try to grow the business. If the investments are successful, the future growth, the future profits that the company generates will be greater than they would have been otherwise, and vice versa. If they pick, they being the company managers, pick a really bad project to invest in, then it really would have been better for the company to return the OCP, return the profits to the owners rather than investing them. Now, no matter how successful investments are for a given company, after some time, the investments are going to have less and less effect on growth of profits. There are many reasons why this happens. One is simply size. When you have a very large company, you have to invest in very big projects in order to make a big effect on profit growth. So now we've got all three of our valuation drivers: revenue growth, profitability, and the amount that we are spending on investments and their efficacy. A good analysis will allow an investor to understand the dynamics of these drivers over time. Good analysis will show why revenues are increasing over time. It'll show what the trends are of the company creating profits out of those revenues, and also show how much the company is spending on expansionary projects, spending on investments, and what the cash flow flowing to owners looks like after it does that. Now that we understand what we're looking at when we're looking at drivers, let's talk about how to turn an analysis into an actual valuation. So understanding how these valuation drivers have behaved in the recent past will allow an investor to make some projections about the future dynamics of these drivers. Assuming that you can actually accurately project these future levels and the future dynamics, an investor can understand how much cash flow the firm will generate in the future, and of course, the cash flow that a firm will generate in the future determines its value. Now, whenever we're talking about valuation of companies, companies are very complex, so we cannot be exactly right about any of our projections. This is almost a given that we won't get everything exactly right. What we want to be is directionally right, and we'll talk about this when we look at an actual cash flow model. So, understanding the current conditions that are confronting a company allows us to forecast free cash flows explicitly. In other words, we can think about how revenues are growing, we can think about how profitable the business is, and how much it's spending, and we can say, all right, we just deduct the costs and the investment money, and we come up with the free cash flow to owners. However, these explicit forecasts are pretty easy early on in the near term, but they're harder to make the further into the future you try to do them. And so, as we go out in the future, we're going to use kind of a simplifying dodge, a trick to simplify our analysis. We're going to think about the historical investment efficacy of the firm to forecast the medium-term growth rates. We'll show you in an example exactly how this is done. Now, in the long run, growth rates must average that of the economy at large. This is just the point that after a firm gets to be a certain size, it takes huge investments to move the needle even a little bit. Eventually, the company should be growing just about at the same rate as the economy overall. So now let's turn to an actual discounted free cash flow model and see how these valuation drivers and valuation timing works. So here you can see in the bottom left-hand corner, the squiggly blue line represents my explicit projections for cash flow for this firm. You can see they're squiggly. I've explicitly projected a couple downturns in the free cash flow. And but basically, I'm looking at current conditions and projecting what near-term likely conditions will be. Now, for the medium term, what I'm going to do is think about the investment environment for this firm and its historical investment efficacy, and I'm going to project a simple growth rate for the free cash flows. Here, I've projected 5 years of growth at about 15% per year. If you consider that US GDP growth, the nominal basis of GDP, has grown at about 6% per year, this 15% per year growth is really phenomenal. This indicates a company that has really a lot of very good investment opportunities. Now, as we know from our discussion before, as the firm gets very big, it becomes slower growing. And so we're going to forecast the very long term at the economy's structural speed limit. Let's say we use the 6% rate that I mentioned before. Now, if you look at the shape of this line, you'll notice two things. First thing is it looks unreasonably straight. This is a mathematical model. We're not trying to get all of the wiggles exactly right. What we're trying to do is come up with an approximate values and growth rates that will approximate what the future growth rates actually are. Warren Buffett once said that it's better to be 80% right than 100% wrong. And this is the spirit in which we must make valuations. Try to get it about right. The other thing that you might notice is that this curve is heading up towards infinity. And of course, stock prices are not infinite. As they get further out in the future, cash flows have less and less value in the present. And this process of discounting cash flows is what we do to find the fair value of a company. This dotted line represents the discounted cash flows. You'll notice that it's beginning to level out after a certain point. Well, this leveling out point is actually the fair value estimate for the firm. In this case, $1,275. Now, of course, real-life valuations seem a lot trickier than this, but in essence, this is what is happening when an investor is analyzing a stock in a fundamental way. Now we know what valuation drivers are and how to use these valuation drivers to project the value of the company in future years. Let's now turn to how to use the YCharts 1% focus report to make this an easier task. So the 1% focus report is designed to be a form of graphical financial statement analysis. Rather than digging through all of the financial statements, you can take a look at one of these reports and get a very good idea about each of the valuation drivers. Also, we include a focus section that has an in-depth analysis. This is an experienced analyst taking a look at the company and what makes it tick. What's the essential facts about its business that is necessary to understand to value the company. Now, each of these reports use the YCharts Excel add-in, and it also hinges upon what we call the value score. The value score is a quantitative valuation metric, and I talk about this more in other documents and in other presentations, so we won't go into it in depth here. Now, how is a 1% focus report laid out? The first page is just the overview and the table of contents, but it gives you a good view of what to expect. First thing that you'll notice right away is a value score of 10. Value score of 10 means that this is undervalued. A value score of 1, contrarily, would be overvalued. Then, as I mentioned, we have a focus analysis. That's first up in the reports. And then that's followed by an analysis of each of the valuation drivers: revenues, profitability, investment levels and efficacy, and resulting in cash flow generation. At the very end, we have a section that talks about market multiples to help you triangulate your valuation with what the market is saying about the value of this firm. Let's take a brief look at some of the pages that you can expect to see. The first page of the focus section also has some summary statistics that talk about how much revenues the firm is producing and where it lies on the value score metric. That's the radar chart you see down there in the lower left-hand corner. It also shows there at the bottom how the stock has performed versus the index over time. This focus section is usually a couple pages long, and it's followed by the graphical financial statement analysis section. Here, on one page, we cover one driver, or one aspect of one driver. Here we're taking a look at revenues. And you'll see that I'm showing what the revenue change was in previous years, and then the commentary below talks a little bit about what has been driving these revenue changes. You can see in the case of this company, it has a lot to do with mergers. The idea behind the 1% focus reports is to give you a little bit of information and a little bit of a different view on every page that you read. Companies are enormously complex, and so what we're trying to do is allow you to see different facets of the company by looking at different bits of data. Once we go through all of these charts, we'll get to the final section, which shows market multiples. In this case, you can see the price to book ranges. And we also have tables where we can compare the results of this focus company versus the results of other similar companies in its sector and industry. The hope is, with this 1% focus report, to really give you a great aid to making investment decisions, seeing what the investment drivers are, the valuation drivers are, and bringing you to a point where you can make your own sensible valuation of this firm. Thanks for viewing today. Feel free to stop by YCharts if you're interested in the tools that we're using to create these reports. Please make note of that URL and take a look, or feel free to drop a line to the sales team here at YCharts. Thanks for joining.